Hello everyone, welcome back. My name is Arias, and today we're going to be talking about the real fundamentals behind every single business I own, as well as what my relative position is and my cost basis, no matter how painful. Don't forget to like and subscribe if you enjoy this type of content, and leave any video suggestions and feedback in the comments below. And without further ado, let's get into it. We'll start off with the positions that I cut since the portfolio reveal, and a short blurb on why. If you'd like a more in-depth explanation on why I did what I did with these companies, or would like a new video on any of the other companies, let me know in the comments below. Kicking it off are Google and Amazon. I see both companies as good companies with long runways of growth ahead, but I wanted to concentrate into companies that I see more growth and higher returns for ahead. I'm still fairly young, and in times of distress, I want to wander up the risk curve further in search of explosive returns. The next largest position that I cut was Teladoc. I should have cut my losses as soon as I saw that investor presentation with dramatically slower revenue growth versus what I was expecting. That was ultimately the reason I decided to cut my losses and move on, was the slower growth rates and the fact that there are companies that I like more that I think have more opportunity going forward. I still think that telemedicine has a bright future, but it was time to move on. Next largest to go was the ARK Innovation ETF. This is one where Tesla had just been hit again, and I wanted to concentrate rather than having just 10% of that money in Tesla. Next is Facebook. At the time, I sold because I had gotten uncomfortable with what Facebook actually provides to society. I thought and still think that Facebook will likely provide solid returns for investors. However, I didn't and don't want to be involved with them any longer. But for investors that are comfortable with that, they are priced ridiculously well on any valuation basis. Next up is PacBio. I still see PacBio as a company with massive potential growth going forward. However, there are a few companies that I like a bit more, mostly because PacBio relies on having the best technology going forward, which there are no guarantees that they will continue to do this in the fast advancing field that they are in. Mostly though, I just wanted to concentrate into higher conviction companies, but would still be interested in PacBio, especially with how far it's fallen. Health Assurance Acquisition Company, or HAAC, worked as a perfect cash drawer with much more potential upside, and I tapped it for the capital in the crash. I'm keeping an eye on HAAC for when or if they come out with a target, and will evaluate then. And finally, Apple is an excellent company on all accounts, but they just don't have the same sort of growth as some of the other favorite companies. Now let's move on to the companies that I still own. Keep in mind that if you'd like a video about any of these companies, just let me know in the comments. Kicking it off, Block was the company I most recently divested of. In fact, I made the move after I'd already started making this slide, so I decided to leave it in here. Despite Block being more closely levered to the health of the overall economy than many of my other companies, their business is still doing very well despite the economic turmoil. The bull case is still very similar to the one I outlined in my past video on Square, and is based around synergies between their business, especially between their seller ecosystem and Cash App. Square has already started to realize many of the synergies as outlined in that video, and has started to work these two systems together more deeply to allow both of these businesses to provide more value. The Cash App story is still very much alive and well, already having matched their seller ecosystem in gross profit in Q2, and is growing much faster over the past few years, compounding gross profit at an 88% rate over the past 3 years for the Cash App ecosystem, compared to just 29% for the seller business. Afterpay is another accelerant to growth over the coming years, as it integrates very well with both of their main two businesses. A huge vector for upside within the Cash App story is the integration of Afterpay and the creation of a broader commerce ecosystem within the Cash App. This is a massive opportunity, and the success of this commerce ecosystem would be massively valuable. International expansion is yet another avenue for continued growth that has been accelerating recently, and I will be keen to watch that continue going forward. TBD, Block's newly launched Bitcoin initiative, and Tidal provide further opportunities for growth. Their success in the short term will be interesting to watch outside of their financial benefit, as they could show Block's continued ability to create business that will provide tremendous value from scratch that address their mission, building on each other. As you can hear, I still have a huge amount of belief in Block, but despite that, I've sold out of my position and moved into other companies that I have just a bit more conviction in. It's not that I lack conviction in Block, but just that I see other companies have more upside going forward with a similar floor. Kicking it off as my smallest position is Palantir. The real reason I own Palantir stock is because I think they're developing the battle systems needed for the blue side to win. Our adversaries are going to be applying AI to the battlefield, and thus we need to do it better than them so we don't get beat. Of course, the real economic opportunity that has come in developing Gotham is Foundry, which will be extremely useful for so many companies in the West as they continue to improve and modernize their efficiency. They will be reaching the point of profitability in the next few years, and I have a fortress balance sheet to rely on in the interim. And while many people hate it, I appreciate that Karp does and says what he thinks is right, rather than what everybody else thinks he should. They have a team of excellent engineers working on the next product and improving existing products, and this is where great value will come from in the future. I'm holding on to my Palantir for now and not adding any more because the opaqueness of the company makes it hard to build a ton of conviction in their products. On to the next position, Beam Therapeutics. First, some recent news for Beam. They were part of the formation of a new company, Orbital Therapeutics. Orbital will be an RNA medicine company, I imagine much like Moderna or Arcturus. I like this move with how much white space there is to solve disease and help people with that technology. Beam will own 20% of the company, and this will be another avenue for learnings down the road. Back to their business, where Beam has some excellent technology that has a very real chance to make a positive impact on society. They described in a recent investor presentation how their sickle cell treatment could be the only one with high enough efficacy levels in editing to truly solve sickle. There are still massive issues with how gene editing has to be performed ex vivo, and thus they need to move to in vivo as soon as possible. In vivo editing favors Beam's technology because of how precise their editors are. The problem is just how slow they are moving. They claim that they will enroll their first patient in Q4 of this year, and that they have a path to clear the IND hold on Beam 101. They also plan to make this a registrational trial, meaning they would attain enough data to get an approval from the FDA. This would obviously be huge, but it's still more than a year out. They still have over $1 billion in cash on the balance sheet, and that is sufficient for now, but I would look for them to moderate spend so they can ensure survival. I'm holding on to all of my Beam stock, but I'm not buying any more for the time being, just because of how good the other opportunities I see in the market are. They still have excellent potential, and I am excited to see how much they can help people with their medicines. Moving on to my third smallest position, Latch. I gave my full thoughts in the last video I released, so check them out for more detail, but the long and the short of it is Latch is struggling. It's hard to know how bad it is because they still haven't reported Q2 earnings. The last time we heard from them, they guided way down from where they were expecting for the rest of the year of 2022, which is disappointing, but they theoretically still have a massive market opportunity ahead of them. It will all come down, as it always does, to the execution. They will need to restate their hardware revenue for at least all of 2021 and the first quarter of this year. The good news is that hardware revenue is less important than software revenue for the long-term value of the company. Bad news is that this is still an extremely unusual situation to be in, and I need more communication to feel comfortable purchasing more shares. They did just launch 2 new products for retrofit on buildings that will be widely available later this year, which is obviously a good thing, but we need to see the financial situation cleared up. Until then, while the price is relatively cheap if they end up succeeding, I need to see the finances cleared up before I feel comfortable plowing some more cash into Latch. I need to see the finances cleared up, or at least a little bit of communication, before I feel comfortable plowing some more cash into Latch. I am, however, still holding on to my position for the time being. And my 7th largest position is ARC Genomics Fund. I own ARC-G because I think genomics will improve the lives of billions of people the world over in the next century, and I think this fund gives me broad exposure to this innovation taking place in genetics. This group of companies has been hammered as the Fed has increased interest rates, and I've taken that opportunity to increase my position in the favorites of these companies rather than ARC-G. And while I haven't sold any yet, I may in the future to increase my position in other companies that I have further conviction in, and I won't be buying any more anytime soon, as so many other companies are on sale. Next up is Arcturus. First, with respect to their business, they still have all of the technical advantages that they've always had. Their self-replicating mRNA is still best in class by all indications and has tremendous potential. However, their management has not at all been able to nail down a strategy and execute, while all of the other mRNA companies have been taking massive advantage of the opportunities in the market. They still have all the opportunity in the world to use their technology, and that's what investors are waiting for. They're still expecting an EUA from the Vietnam Ministry of Health for use of ARCT-154 as a booster in the 4th quarter, which would be excellent as they could recognize some revenue and profits and get some real-world data. They also just announced that they will receive $63 million in funding over the next 2 years for a pandemic influenza vaccine, which I think just means further developing their rapid vaccine development capabilities in case of another pandemic. But while $60 million sounds like a lot, it works out to just $5 million a quarter on average. This is definitely a good vote of confidence for Arcturus, and it will be good to watch this company's development going forward. The rubber really hits the road here, with Arcturus' cash pile dwindling down and only expected to last until 2023. With the market as bad as it is, funding is hard to come by. Despite their superior technology, I am considering cutting this position, but I've decided against it for the time being. I really need to see some short-term execution to continue to hold on to this position for the long term, as I am losing faith in their management team's ability to execute. Next up is Ginkgo Bioworks. Ginkgo is continuing to execute on their plan and is showing up in their metrics. They're planning to double their new program count year over year from 30 to 60 and grow foundry revenue 50% to 165 to 180 million. They continue timely tuck-in acquisitions, taking advantage of the tough market conditions with 2 recent ones. First is Alter, a company to improve their adaptive laboratory evolution, an amazing process which I have covered in a previous video on Ginkgo. And the second is Circularis, a company to improve their therapeutic capabilities with circular RNA and promoter screening. I love to see these deals as Ginkgo is accelerating their development on the cheap in the recession. Another recent positive development was a deal with Merck to develop biocatalysts for the use in active treatments. Merck is a massive and successful company, and a deal by them with Ginkgo is not only a great sign of confidence in Ginkgo's development abilities, but also represents a huge vector for future growth if they are successful. In other news, just coming in as I'm making this video, Ginkgo just announced that they have closed the deal for Zymergen. Closing of the deal was expected, but the speed with which this happened was incredible. It was less than 90 days from when they went public with the deal to when Zymergen shares stopped trading and the deal was done. This is all despite Ginkgo themselves at the time of the announcement expecting a close in Q1 of 2023, meaning that they were a full quarter early. This speaks to Ginkgo's masterful execution and gives me confidence in their management going forward, being more successful in acquisitions. Ginkgo continues to learn and grow and has an absolutely gargantuan market opportunity. As for Ginkgo, I'm still picking up their shares as I have massive belief in their future. Coming in at my fourth largest position is Invitae. Invitae is in the middle of their business restructuring and has been trying to remind investors that their cancer business could be very valuable in the future with a whole bunch of press releases. They also recently announced that their data from their Citizens platform has been used in a filing for a new IND by Perzaxis. This emphasizes the potential of their platform and is just one of the uses of their copious amounts of data. But while they said that their data was useful and a critical component of development, I'd like to hear more details on what exactly the data was and exactly how much it accelerated development. Before I pour some more money into this business, I need to start to see the right sizing play out, and I would love to see their 2024 converts refinanced, despite how bad the debt markets are. But with reference to their business, Invitae still has some excellent technology, from their genetic testing capabilities to their cancer diagnostics and monitoring, and the potential flywheels that these create. Invitae has crazy upside if they can make it through the impending recession. But I can't look past their finances to the technology, and thus, until I have more certainty around their financial future, I'm going to be holding on to my Invitae shares. I'm definitely going to consider picking more up after the Q3 earnings, mostly depending on the commentary from the management. Rotting its way all the way up to my third largest position is Recursion Pharmaceuticals. Last time I showed you my portfolio, it was my 13th largest position, and while some of this is due to me adding shares of Recursion stock, Recursion has also displayed massive strength compared to most of the other positions, as you can see here. Their business is firing on all cylinders, launching 2 more clinical trials in December, one for FAP and the other for Diff Colitis. That brings the total to 4 trials on the year, 3 of which are Phase 2 or 2-3 proof of concept, and 1 Phase 1 trial. The Phase 1 trial, launched in September for Diff Colitis, is of particular note because it's Recursion's first new chemical entity to go into the clinic, while others are just novel uses for current entities. Recursion had 2 recent investor presentations. Of course, much of it was just rehashing stuff you already know if you've watched my previous videos, but there were 2 especially interesting highlights that I want to bring to the fore. First, they said that they would be willing to do new deals with other big pharma companies, but they were very specific to say that they would need to be runway extending. This is good to hear that they are focused on this with their cash on the balance sheet dwindling and the market conditions rough. As of the end of Q2, they had $515 million in cash investments and equivalents on their balance sheet and lost $66 million in Q2. That leaves them with about 8 quarters of runway. So it's time to start looking for additional finances to keep them going in 2024 and beyond. The other announcement that I was super excited to hear was that they are developing a system for automated synthesis of new compounds. This has profound implications when integrated with their automated lab. With some clever engineering, this may allow them to send machine learning algorithms to try and tackle certain diseases. The system could predict the results of applying certain compounds to a disease, and then rapidly synthesize the compounds, test it, and categorize it, and then use it as feedback to continue to improve. Of course, the more times they run this loop, the better predictions the machine can make going forward, and the more accurately this development can be executed. And while this is all purely theoretical, as I don't know exactly how they plan to use the system, there are crazier things going to happen with how fast AI is moving. With regard to the stock, I have added some Recursion recently, but not too much. I am interested in adding more, especially if it catches up with the market and really gets hit all the way back down to the $5 range. All that said, Recursion is still executing on their goals, and I am excited to watch this company grow moving forward. Coming in as my second largest position is Lemonade. Lemonade is continuing to do an excellent job expanding their business. They have just recently launched coverage in the UK, their 4th market in Europe. This launch shows their continued execution on their expansion plans, and they will continue to expand both the number of markets that their services are available in and the number of products available in each market. This obvious statement starts to get to the key bull case of Lemonade, which is the compounding benefits of growing the customer count in addition to growing the spend per customer, which will continue to compound revenue for a long ways to go in the future. They also just launched crop insurance in sub-Saharan Africa as part of Lemonade's Climate Coalition, which allows subsistence farmers to insure their crops for less than $1 using their cell phone. It uses the blockchain and an oracle to determine the ground truth and pays out accordingly. It is important to point out that not all of this was developed by Lemonade, and they have partners in this endeavor, but Lemonade no doubt gains the technical expertise from this initiative that could be part of their future efforts to make their business even more lean. This is not going to contribute to Lemonade's business, as it is part of their charity, but is still a super cool effort that shows the viability of Lemonade's digital-first architecture, and it will have a meaningful positive impact on those who need it. Car insurance continues to roll out methodically and should have a huge effect on their key business metrics as it expands. The success of car insurance thus far shows how their business is set up to succeed with the massive expansion of dollars spent per customer on Lemonade. They did mention that they will keep this rollout methodical to minimize losses from early customers in their business, and this makes sense with the brutal business climate. Keeping new business losses down will help them get to break even sooner, which will de-risk the business massively. However, this will mean lower growth in the short term. And while it's disappointing, if it ultimately means that they are around in the long term, then it is without a question the right move. Lemonade currently thinks that they have enough cash on hand to make it to profitability and be around long term. The last thing I will mention is that Daniel Shrabner was in an interview with Matt Smith and Emmett Peppers on the Good Soul Investment YouTube channel. While most of the comments reaffirmed what we already know, one insight that stood out to me and was first pointed out by Paperback Investor was how fundamentally different Lemonade's digital-first model is from legacy insurance, specifically to their cost structure. Lemonade is incurring huge losses right now, primarily related to acquiring customers. Legacy insurance is still very much entangled in their agent model. These agents provide some value in customer acquisition. They can take a decent chunk of the premiums in perpetuity. So while these companies don't pay up front for their customer acquisition, they do pay in perpetuity for the service of these agents. This is yet another example of how Lemonade's digital-first nature will be a huge boon for them in the long term. Lemonade, while risky due to the market conditions and lack of profitability, they do still continue to execute on their plans. Coming in at my largest position, and it really isn't close, is Tesla. Tesla is executing on all cylinders. I thought AI Day was an amazing presentation. With respect to the bot, where they are at right now isn't really all that important because it is still so early. What's more important is their rate of progress, and to go from nothing to a semi-functional prototype to working on a version 2 within 12 months is nothing short of extraordinary. And the body is the relatively easy part. What will really be a challenge is building the useful brain, which Tesla has an excellent base to build off with FSD. Long-term, TeslaBot will solve the problem of manipulating mass in the world in combination with cheap energy harnessed from the sun. This will be the next unlock for humanity and will eventually lead to AGI, the ultimate product. Dojo is another incredible effort to solve Tesla's massive need for compute, which is large and will only grow going forward. If successful, it will become another mode of Tesla's, as they will have the most compute at the best price. At that point, Dojo as a service will become a real possibility. Perhaps the largest benefit of Dojo is that they will have enough compute to allow the brilliant engineers at Tesla to iterate faster than anybody else in the world. They are already moving faster, but Dojo will serve as another accelerant to that. FSD will be an insane unlock for the world, freeing up the time of billions of people and enabling the movement of billions more. But the bot will dwarf this, and it isn't close. As for Tesla's traditional car business, there will be some demand pockets with global turmoil, but Tesla will still sell all of their cars as the transition to EVs is inevitable. Tesla also has the best margin of anyone in the world making mass market vehicles, and the smartest engineers working every day to improve their manufacturing processes and bring this cost down. So, if they have to take some temporary hits to margins to continue to sell all their vehicles, it will be insignificant in the long term. I think Tesla is a beast of a company. It has been unduly punished by the markets, and thus I've been buying more Tesla than any other company recently. I am very comfortable with the majority of my net worth in the company, and I can handle the short-term volatility because I do not have any margin or derivatives. The sky is the limit with Tesla's ambitions, and I hope one day to work there and contribute myself. Finally, for my conclusions. Some of my companies are definitely struggling, and it's been compounded by how terrible the market conditions are. However, most are doing just fine, continuing to execute on their plans and make progress, even if a bit slower towards their ultimate goals. They are all being slaughtered in the market, but this just gives opportune investors a better price to keep piling money into the market. In this crash, I will continue to do just that, continue to buy my favorite companies for the next few decades and hold on long term, and even sell some that I like just to buy ones that I like a bit more. Thanks for watching. What do you think of all these companies? Which would you especially like to hear more about in the future? Let me know in the comments below. Thanks again for watching and have a great rest of your day.